Today we are going to be looking at a trading strategy that delivered 602% returns with half the risk. This trading strategy is mainly developed in crypto. The original paper was in equities, but I translated it into the crypto market. So let's start. Basically, we started this equity curve with $100 and simulated all the specifics of the strategy and ended with around $703, which is 602% plus the initial balance, right? Even though it has underperformed BTC and altcoins on an absolute basis, we will find that these returns are achieved at a much more consistent rate. All right. And that's basically what we want, right? When we are looking for trading strategies, we want to be looking at those with the highest risk adjusted returns, not only those with high returns, because that's irrelevant. I could easily leverage this trading strategy here to have the highest possible returns. And yeah, it would beat the benchmark, but it would do so at a much higher risk and drawdowns and volatility. So that's not real outperformance. Outperformance is when you beat a benchmark based on risk-adjusted returns. All right. So the first thing we want to look at is the total annual return by year. Right. Let me get here the pen. We can see that even though there has been some massive years in altcoins, for example, some massive years during 2017, 2020, 2021, there also has been very bad years, right? For example, in 2018, we had an 84% drawdown in altcoins and a 71% drawdown in BTC. Even more recently, in 2022, we had a 64% drawdown in altcoins and 63% in BTC. So even though there has definitely been some years where returns are really high, there has also been years where the drawdowns are really low. Imagine having like a $10,000 account. Let's say you have a $10,000 account to trade and you go through an 84% drawdown. That means you just lost 8.4K of your total equity if you had 100% at the peak of that drawdown. That's a lot of money. To recover that, you have to earn a lot of returns to get back to what it was before. So this strategy, for example, while altcoins lost 84%, the strategy made 77%. While the strategy lost 64% in 2022, the strategy held its returns and actually delivered a 2% return. All right. So in terms of consistency, this strategy offers something that just a general buy and hold of cryptocurrencies doesn't offer. And that is something that we look for, right? During the research, we discovered that this strategy, like I said, produced a 603% returns with much lower risk. And not only that, it limited the maximum drawdown from 92%. That is the altcoin market has had an historical maximum drawdown of 93%, and we delivered actually 33% with this strategy, with a Sharpe ratio of 0.99. So you can see that even Bitcoin delivered the maximum drawdown of 83%, while altcoins delivered 93%, and our strategy only delivered 33% during this time. All right. Naturally, with reduced drawdowns and reduced volatility, you'll get reduced annualized volatility, right? So our strategy had just 31% volatility during this period, while the market offered 82% volatility. This is a massive difference. You can see here, right? Volatility is important because it basically, to keep it simple, measures the daily swings of your equity curve, right? If you have something that is extremely volatile, it's hard to hold through most of the times, and you'll experience significant drawdowns like we've seen above. And so reducing the strategy's volatility is very important so that we can be more efficient with our capital allocation, basically. The average drawdown length is also important, was reduced to 40 days on average, which opposed to 75 days for the market. So instead of spending on average 75 days on drawdowns, so around 2 months and a bit, right? You now spend in a month and 10 days on average drawdowns. So that's another potentially beneficial feature that we want to see. Now, in terms of risk management, what we did here to achieve this, we capped our maximum leverage at 2x the account. So at any given time, the equity that we have exposed to the market, so imagine that you have $100, all right, and you are looking to add another position here. But the total realized and unrealized P&L that you have right now on your equity curve gives you $200, right? So you cannot, in this approach, you cannot open any more positions because you already have your account leveraged. I call it leverage, you can say exposure, whatever, to 2x what is your current balance. So this is the balance, 100. If you have total unrealized P&L of $100, 100 plus 100, you have $200, so you cannot open any new positions. That's only to ensure that we don't get massive leverage positions and that we can keep our account to the standards. In terms of position size caps, this just means that how much position size do we allow per position, a maximum position size, and how many signals we allow per day, which is 20. I don't want any more than 20 signals in my account. I do think, and I can do more, I can share more research on that later. That is, the more signals that you add, the more you dilute the strongest signals, okay? So 10 signals, 20 signals is fine. Above 20 signals for a single strategy, it becomes difficult to manage. And my opinion is that you are diluting the effect of the strongest signals in your portfolio. You can see that over time. This is a tracker that I built that tracks the open positions at any given day. This is daily. And you can see that the total positions in green never go above the 20 line. Here was a day that it probably closed one position and opened another one. So you get here a spike above 20 at 21, but it's not real. And you can see that the total positions fluctuate between 20 and other values. Our position sizing methods, okay? How did we size positions? So let's say that you want to enter a position in BTC or you want to enter a position in Doge, all right? Or in Doge. Both of these assets have different volatility profiles, right? One might be at 60% or annualized volatility, other might be at 100% annualized volatility, and you want them to be equally contributing to the P&L to the volatility of the portfolio. So what we do, we take the target volatility that we want. I target it at 40%. We divide it by the maximum signals, which is 20 signals, and we divide it that by the annualized volatility of the coin, and multiply it by our portfolio size. And this formula gives us a position size that contributes equally. So when we have something like BTC or Doge on the portfolio, this is the allocation to each of assets is, how can I say it easily, is allocated in a way that so Doge, for example, you have 100% volatility, you reduce size, so you have less size here. And since BTC 60% is smaller than Doge, we increase the size compared to Doge so that both equally contribute the same volatility to the portfolio. all right? So that way we can trade different types of assets within the same volatility contribution. Here we explain it a bit better. Volatility targeting at the start of a position means sizing the initial position based on the expected risk or volatility, without adjusting it later to maintain a target volatility. It ensures that higher volatility assets get smaller positions and lower volatility assets get larger positions, so that we can keep the volatility or risk exposure consistent across multiple trades. So everything is equally sized. Then we have here a few performance benchmarks. We already talked about a few. For example, the maximum drawdowns, for example, for the strategy is around 500 days, and for the benchmark for BTC and for crypto in general is over 1,000 days, probably 1,100. So it's less than half the maximum drawdown duration, and we can see that because as the for example here in 2021. As the strategy is making new drawdowns, hour is going up, and as it is drawdown, hours is breaking above the all-time highs here, right? Even though it has drawdowns, of course, it recovers much faster because we are doing both long short. And here we can see it recovers, and so the drawdown, since it's more consistent, the drawdowns are recovered much faster as well. And that is achieved through both long short positions like we said, so we can capitalize on both the long and the short side of the moves, but we can also capitalize by adjusting our volatility like we just talked here, so that we are not allowing too much volatility from assets that are not as stable, and we are forcing assets that are lower volatility to contribute more volatility to the portfolio, so that everything stands in line. Okay, in terms of percentage of winning trades, this is an interesting one. You can see that our strategy only wins around 40% of the times at the individual trade level, and loses 60% of the times, which is natural for a momentum type strategy. In terms of the risk-adjusted returns, there's something interesting here. Even though we don't beat the Bitcoin benchmark, which has been a massive performance, Bitcoin alone has been a massive performance, we do beat crypto altcoins, all right? For example, the return to average drawdown ratio, we beat Bitcoin, both Bitcoin and crypto markets by a significant margin. In terms of return to annualized volatility, we also beat altcoins to a significant margin, and to the total exposure ratio, we don't beat them. And this makes sense because we have less returns, like we talked about. And since both the three strategies, one is these two are buy and hold, and this is also exposed to the market, both long and short, so 100% exposure to the market, it's natural that the total return to exposure ratio be smaller. What I want to say is that if someone trades altcoins, and that's me, basically, having a more strategic approach other than holding through 90% drawdowns might be beneficial, and this strategy provides that, all right? And if we go below to the signal generation methodology, I reserve the complete, even though I tell you what it is here, it is basically an RSI modified strategy, and I'll tell you what do I mean? I reserve the full implementation and all the details to my newsletter subscribers, because this is where I put all of my research. I spend hundreds of hours making sure that all of this data is as accurate as possible. I don't like sending results that are not accurate. This is trading a multi-strategy. So my infrastructure trades all the assets available at the major exchanges. It handles a bunch of position management strategies. So they do take a lot of time to build up, and so I reserve them to my newsletter. But in general, the signal is just basically an RSI that is modified. We make the readings of the RSI when they are overbought or oversold amplified. We amplify them so that the risk so that when you get readings that are extreme, we make them even more extreme so that you can scale the signal at the most extreme signals, and you get something different than a basic RSI, basically. And yeah, that's just the idea, is making extremes even more extreme so that they get more weight in our signals. All right, and we can see that even here the annual Sharpe ratio, which is an important risk-adjusted metric, we do also have like 0.99 here, 1.58 when the market delivered negative, 0.5, 1, 1, and we have here a positive when the buy and hold of the market was pretty negative, and we have 0.90, 0.97, and 268 this year, while altcoins have been negative. So the strategy itself offers a very interesting risk profile. I'm very interested in the strategy itself, and yeah, this is our 60th research article, and we'll be doing many more. Thank you.